in the CPI, okay, 0.16, all right? 0.16 was the reading. Everyone says 0.2, but let's do 0.16, okay? 0.16 times 12 is 1.92% over 12 months. That's under 2%. That's under the 2% target.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Newport Beach. That's actually the Newport Beach back there. If I can zoom in and get you some love. Nope. But it's right there. Got my AirPods in, so unfortunately not going to be able to hear the breeze and the ocean. But you were with a fireside chat with KP right here. I told you we're finishing up the summer here. We got a week until school starts. Love seeing all the pictures of all the beautiful kids going back to school. We are here on Newport Beach Peninsula. And I always say we. It's just my family. And a buddy who works for an AI company called Cohere. They're a big bet that Oracle's placing. Bet you hadn't heard Oracle. Everyone's hearing Microsoft with OpenAI, and they're hearing Google with Bard and all their stuff. But don't sleep on Larry Ellison and the board there at Oracle. Anyway, so why is the bond market 10 basis points higher than my video I did for the beach here last Thursday? Remember, we mentioned that the CPI data was pretty good, yet the 10-year Treasury went up to 4.1%. Today it touched 4.2%. So remember, we're talking about stocks and bonds. We're talking about buying and selling money. And again, August is a kind of lower volume trading type environment. So bond vigilantes that see our government increasing spending without increasing taxes, and they want to make sure that they get a yield for their investment in our treasuries. And it's all good as long as inflation keeps coming down, and inflation is coming down, but it didn't come down enough. Last week it actually went up on the CPI print last week, even though we know it's a great trajectory we're on. It went up from the prior month. So on the headline number, and that includes food and energy, which is a big part of our inflation. So if you believe inflation's going to stay higher for longer, and thus the Fed has to fight inflation with higher for longer interest rates, even if they don't even do another raise anymore, even if they're done, we're at 525 to 550 on the Fed funds rate. So if they keep that higher for longer, because inflation remains elevated and not down to the 2% target, what you start to see is duration expand out on a lot of these bond strategies that are out there. If we're at a higher for longer, higher inflation environment, that's a drag on the economy for longer. So it's not like, typically when we fight inflation, Fed raises the rates, we see a waterfall dive once a recession kicks in. But there's a lot of talk about a no landing or a soft landing and all these things that have to do with recessions playing out where the economy is still in a good position. I don't know what the outcome will be, but I know unemployment is still very low. Able-bodied working men and women ages 25 to 54 have a ton of side hustles. I read a stat about men specifically that like in the 60s, 97% of that working age male was working. Now, 1 in 9 are not only not working, but they're not even seeking employment. And that's according to the way the statistics are collected with the Bureau of Labor Statistics. And so what are they doing? These side hustles, I read somewhere as much as $1 trillion in money that's just on the side, that's being, it's kind of a side gig economy. That's a big part of our GDP. 1 in 9 men working in side gigs and side hustles in basically untaxed income, if you will. Not all of it, but most of it. And it is in the economy, obviously, so it's part of creating jobs and whatnot. So again, we buy in some money, and that liquidity that we have, whether it's jobs, income. Remember, I talked about GDP plus last week, which is gross domestic income together combined with the gross domestic product. That's a stat that's looking at the underlying economy. But what's interesting is the Atlanta Fed today said that they think there's going to be a 4% GDP here in Q3. Now, that's because we're exporting a lot, and we're exporting a lot of energy and food. So I'm not in the food or energy business, and most people I know are not. So your everyday person doesn't really benefit from that, even if the economy is stronger at 4%. And so, energy prices have gone up. I'm sure you've noticed Texas, West Texas Intermediate crude, Brent crude, the price per barrel barrels of oil have gone up into the $80 range. And that typically peaks around Labor Day. That's when the travel season's over. Everyone goes back to school. We're done traveling as much. Of course, not for conference season. That kicks off pretty hard here. Western Secondary coming up next week in Dana Point. But there's certainly a lot of travel coming up for all of us in September and October. It's pretty brutal, actually. But generally, people stop taking road trips. And if demand can come down considerably, and the oil supply in America is at an acceptable level, that's how you really bring down inflation, especially the headline numbers in CPI. Now, if we were in a recession, demand can fall again, a waterfall dive, a very quick, lapse in demand for oil and gas and energy, and it can cause, it be another one of the signs of a recession. So, look, Saudis have been cutting oil multiple times, and yet the price of oil, is still going up, obviously, with less supply. But the demand side is something that we're going to see where it plays out in September and October and how that impacts inflation. We have 40 days until the Fed meets on September 20th, and we'll have some more inflation data by then. Now, don't forget, Fitch downgraded U.S. debt. So it went from AAA, the highest rating, to their second best rating, which is AA+. So they downgraded the U.S. debt. And it seems kind of silly, but I think that's playing out in some of the bond markets and some of the higher interest rates we've been seeing right now. You've got a lot of competing currencies around the world, competing economies, and it impacts our dollar. Plus, the 30-year Treasury auction last week was less than average. So we're kind of in that, feedback loop where we just bounced off that. Don't forget, Moody's also downgraded a lot of banks or put them on watch. 10 major banks. So is there stress in the financial system? Remember, we're in the financial services business. We buy and sell money. So it's not good if banks are going through financial troubles. And I'm not saying that they are, but these ratings agencies, when they downgrade debt or banks, it does have a ripple effect in the world of money, buying and selling money, which impacts our higher interest rates. Don't forget, August 22nd, BRICS. The BRICS are going to supposedly let Saudi Arabia in their BRICS Plus. Now, those Brazil, Russia, India, China, South Africa, and Saudi Arabia make up 54% of the world's global GDP. So something like 40% of the population too. So be interesting to see all these forces trying to combine and hate on the dollar. Still betting on the dollar, still betting on our technology. I read that capital expenditure is expected to be at $900 billion, according to Goldman Sachs. $900 billion that the S&P 500 companies are spending on CapEx. That's capital expenditure. That means investing in stuff like AI, investing in technology. And they wouldn't be doing that if they didn't think there was going to be a return. So that number is for 2023 and 2024. AI is a big part of it. My buddy here who works at Cohere was telling me about, some of the things they're working on. They're working on, infrastructure, AI to help with applications, and then also, services. So, putting AI to use in a real way is going to be very, very big for all industries, including ours. Hope to see you all next week at the Western Secondary. Big retail sales number out tomorrow. Home Depot reports before the bell, and so does Target before the bell on Wednesday. So we will see how the consumer is doing, which consumer spending is 70% of our GDP. Big data coming out tomorrow and the next day. Have a good one. Cheers.
Hey, it's KP coming to you live from Corona, California. What is going on with the 10-year Treasury and rates and everything else? Don't fight the Fed. Don't fight the Fed. Now, I'm going to make some predictions here. I'm going to try and wrap my little brain around everything that's been going on this year and what we did not account for. And then if I say something like, hey, I told you we're headed for a soft landing, well, then, of course, we'll go into a recession tomorrow. But let me just say this. Don't fight the Fed, in case you forgot. They are in control. Remember, the Fed flooded our economy with trillions of dollars to stave off a global health crisis and pandemic. That money helped set historically low mortgage interest rates, the lowest ever. And there are so many people in America with equity, free and clear homes, low payments if they have a mortgage, where they are able to have excess money to spend on things like going out to dinner and services and travel and whatnot. They're not buying the big ticket item goods, but they're spending money, whatever they have left, above that debt to income ratio. Remember, that's something that we calculate every single day on our loans here. You know, if you have lower mortgage debt and it's fixed in for 30 years or forever or for whatever, then, you know, you've got excess money. And people had growing wages. The economy has been strong. The job loss recession has not happened. You know, a lot of people at the beginning of the year, and myself included, thought that we would see slowing growth. I was never in the full-blown recession camp, but I thought we'd have slower growth. But the majority and the most conventional wisdom out there is that we would be in a recession this year. This year, we would be in a recession. So the Fed came out, and we could see from their minutes released from the last Fed meeting, they are saying there will be no recession at all. So now, of course, they can course correct based on any data that they are saying they're, quote, data dependent on. But if they're saying there's not going to be a recession, and we don't think there's going to be one this year, we're going to see higher yields on the 10-year Treasury because the economy's strong and growing. By the way, the Atlanta Fed just came out and said a 5% GDP for this quarter, for July, August, and September. 5% growth. Now, a lot of it has to do with, us being, an exporter as a country of food and energy. I talked about that on some of our past videos here together. And the Fed got it right. The Atlanta Fed, their economics team said that, they're going to have, 2.4% GDP in Q2, and they were right. So if our economy is growing, not a recession, and jobs are steady, we had jobless claims out today, about expectations, nothing too crazy. Unemployment rate's still low. A trend that I brought up in the pandemic, and I kind of touched on it a little bit recently, is that so many people have a side hustle, the side gig economy. There are estimates, hard to track it, right? I mean, imagine if you're the Bureau of Labor Statistics, you're a government agency. BLS sounds a lot like the IRS. And you're on the household survey, and you get a call from the government, and they're like, hey, we're just doing this survey to put out the jobs report that comes out the first Friday of every month. I want to ask you some questions about your employment. Okay, sure. Do you have a side gig? No. Do you have a second job? No way. No, not me. No way. You think you're going to tell a government person on a household survey you have a job that they could now trace and track you and tax you on? The estimates I've seen, this is the high end, okay? This is just kind of an outlandish number I'm throwing out. But I've actually read it in pretty, credible research teams. I mean, I tell you, I subscribe to a lot of research, a lot of stock analysis. I don't watch the news. I don't watch politics. I don't want what little emotions I have played with by some talking head on the TV. I want to see what people who are trying to make money think. And a lot of these stock analyses that I read, they said there's as much as 30% of our employed workforce, working age people, it's what, 24 to 54. 30% have a side hustle. As much as $1 trillion floating around in income in our society. And that's big for GDP. So we don't have 2 negative GDP quarters in a row, or whatever the Bureau, the National Economics Bureau, whatever they're called, that decides a year later whether you were in a recession. They may decide last year was a recession and we're out. So wouldn't it be okay to think that 10-year treasuries go up? Now, it feels like a recession in our business because we have too many loan officers doing, a loan every 90 days or once. I read some chat board the other day like, oh, I haven't done a loan since May. Get out. What are you doing? Leave it for us as professionals. If you aren't funding at least a couple of loans a month, you need to change something about your business model, and you got to work through it. You got to get good at non-QM. You got to get good at your technology. You have to grasp enterprise level technology, combine these tech tools together and market and pound the phones and find solutions. Same thing with realtors. We have too many realtors and too many originators. Last year was too much capacity. This year it's too many salespeople. And we are a capacity industry. Remember, we did over $4 trillion in business a couple years in a row. Well, now there's under 2. And so, maybe we hit 1.6, 1.5, 1.7. I don't know what the end number is going to be. Maybe it's 1.4 for the year if rates stay this high. So we're deleveraging. Housing is certainly feeling like a recession because we're very interest rate sensitive. So when I say don't fight the Fed, don't fight it. When they say we're going to keep rates higher for longer, they are going to keep rates higher for longer to fight inflation. Now, they keep rates up to bring inflation down, and eventually mortgage rates will follow that fight. But the Fed and many professionals out there think that the battle over inflation has not been won yet. So I'll break that down in just a second here. But if we stay in the high 3s or 4s higher for longer, then the Fed's got to keep their Fed funds rate higher for longer until something breaks, whether they break inflation, break the labor market, break a bank, break some system that causes them to have to bring, okay, all right, now people are fearful. Now we have this event we didn't know about, or the economy is breaking down, slowing down. But they said it. They don't think it's going to slow down to recessionary levels. Below trend growth, not a recession. So in the CPI, okay, 0.16, all right, 0.16 was the reading. Everyone says 0.2, but let's do 0.16, okay? 0.16 times 12 is 1.92% over 12 months. That's under 2%. That's under the 2% target. And in that 0.16, there's still room for some of the housing components to come down. Remember, it's a big chunk of CPI data. Rent can come down. Owner's equivalent rent can come down. Heck, even housing prices can slow down with these higher rates like they did the second half of last year. Remember, June through November, they started to come down a little bit. Some reports maybe even officially through February, but then came back up because, just some price action, supply and demand. So there's still room for car prices to come down. They've been coming down. Gas prices have been coming up. That's not part of core CPI, but typically gas prices peak right around Labor Day weekend because that's when travel stops. People go back to school. Things start getting colder. People hunker down, So that's a demand-driven industry as well. Even if there is less supply and OPEC Plus are cutting supply, demand can get under that supply. So we're not seeing that in housing, but with higher rates, that could affect demand as well. So we got to change our business models, got to go after cash out borrowers. I read a great article here on LinkedIn, Selma Happ, economist over there, CoreLogic, talking about 25% of homes are investment properties, and most of those are owned by people who own 3 to 9 units. It's not even big institutional investors. So the 10-year Treasury, I read, has some real resistance at 4.33%, which it touched on today but did not close. Tomorrow is the third Friday of the month. It's a huge options and futures expiration date. The third Friday of every month. Now, I'm not a financial advisor. I'm not responsible for your losses, only your profits. But everyone who started to come in off the sidelines, oh yeah, let's get on this tech boom. Let's start, Start betting. I want to get on that stock market. They start buying options to compound their winnings. And now institutional players are selling the stock prices down. Those bull bets on options are going to expire worthless. So we might see some liquidity come back into the market next week. Or maybe after the Jackson Hole comments, certainly into the Fed's comments on the 20th. Tons of good stuff about our economy. No landing, soft landing, I don't know. But we just got to roll with the punches. Have a great weekend. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.